Can we get much higher? So high.
Hi everyone, I'm Melanie and we're Team 1 and we're here to talk to you today about sales tax. So to get us started with the definition of sales tax, here's Jay.
So thank you, Melanie. I will begin by giving you a little introduction about sales tax. So sales tax is a tax which is applied on retail sales, leases, rentals of goods and services. All sales taxes can reach a maximum of 8.25% depending on Texas city, counties, authorities or districts. So let's see to whom does the sales tax system apply. So each person involved in doing business in Texas must collect and pay the required amount of sales taxes. To do so and to collect and pay sales taxes, every business must have a sales tax permit. The requirements to get a permit are to own a business in Texas. Thus, a storage yard or a manufacturing plant are not considered as an active place of business unless 3 or more sales are incurred during 1 year. The second one is to sell tangible personal property in Texas, and finally the third one is to have a lease of tangible personal property in Texas. So how to get a sales tax permit? So first of all, there is no cost charged to get a sales tax permit. The legal entity who wants to get a sales tax permit must submit an application on the Texas Online Sales Tax Registration System. And so to get an application there are 3 ways. The first one is to download the document from the tax forms online website or to call phone number 800-252-5555 or directly to go to a local enforcement field office. So how many sales tax permits are required and what are their validity? So first, if you are running several active businesses, you must have different sales tax permit for each of your business. Each sales tax permit will feature the same taxpayer identification number, but the outlets will vary. Besides, a sales tax permit is only valid for one business's owner who originally received the permit. Thus, if there is any change in the ownership of a business, like an acquisition, for example, a new permit must be issued. And also, a sales tax permit is only valid for one active business. Thus, if the owner is not engaged anymore in the business, the permit has to be returned to the controller in order to be cancelled. Are the business's records subject to audit? Yes, the business records are subject to audit, no matter if the seller's payments of tax are up to date. The aim of the audit is to find out if the seller is eligible for refund, owes tax, or paid the right amount of tax. Thus, in order to facilitate the audit, the seller must keep records of each transaction. What are the obligations of a Texan permit holder? There are 3 main obligations. The first one, he or she needs to display the permit at the location of his or her business. Then he or she has to collect sales tax on taxable items as well as pay sales tax on taxable purchases. Finally, he or she must keep precise record of all operations. Now let's talk about the sales tax collection and what is taxable. So any sales on a taxable item is taxable except if there is an exemption applies. For example, Texas law defines a taxable item as tangible personal property and taxable services. So how to determine the amount of sales tax collected from customers? The amount of sales tax collected by the seller are calculated by using a tax rate. The seller finds the total amount of sales tax by multiplying the tax rate by the selling price of taxable products. The tax rate used in Texas is 7.25%, yet local jurisdictions such as cities, counties are allowed to impose the use of a higher rate up to 8.25%. Thus, the seller must collect and be conformed to both states and local sales tax systems. Moreover, the tax rate information for a particular location can be found by using the local sales and use tax rate information. So, a problem in rounding can occur when calculating the total amount of sales tax. So, the seller must round and he must or she must look at the third decimal and follow the following rule. So if the third decimal is equal or greater than 5, the seller must round up to the next cent, and if the third decimal is 4 or less, the seller must run down to the next cent. Does the seller need to inform his or her customers about the amount of sales tax? Yes. In addition to collect and keep records of sales tax, the seller must notify to his or her customers the amount of sales tax included in the total price, for example by providing a written statement. Quick question, are the barters and exchanges considered as taxable items? Yes, barters as well as exchanges are taxable items, so sales taxes must also be collected and recorded for that type of transaction. Also, shipping and delivery charges are taxable only if the item they are associated to are also taxable. So, to be clear, if you sell a sofa, for example, which is taxable, the shipping fees are also taxable. So in the case of buying a business, the new owner will hold the responsibility as regards the sales tax owed by the businesses acquired. The only exception is if the new buyer possesses a certificate of no tax due, who he can get it from the controller before making the acquisition. So in order to get the certificate of no tax due, the buyer has to send a request for this certificate to the Texas Comptroller of Public Accounts in Austin. There is also the possibility to request a certificate by phone at the following number 512-475-0349. Moreover, there is no fee associated to the process of asking a certificate of no tax due, and usually the waiting time is about 5 days, but the process can last 4 or 6 weeks if the audit is required. And now I will let my teammate Devin talk about which states do not have a sales tax.
Thanks, Jay. Now that we've heard a little bit about sales tax, which states don't have a sales tax? Alaska, Delaware, Montana, New Hampshire, and Oregon are the only states that currently don't have a sales tax. All the other states have sales tax that range from 4% in Hawaii to 8.75% in California. Most states allow cities and localities to charge tax on top of the state sales tax. This means consumers are often paying upwards of 10%. So how does sales tax affect small businesses? Sales tax on a small business raises the price that must be charged to the consumer, and this means a higher tax on a product or service is going to mean a lower demand. This change in demand causes the business to make a decision between either lowering their price and taking a profit hit or passing along the price increase to consumers. The government monitors each of the various industries very closely in order to know when incentives are needed in order to help a struggling business. So next is going to be internet sales tax. Currently, not all online businesses charge a sales tax. Y'all know that from Amazon.com. If a business does not have a physical presence in a state, they are not obligated to charge sales tax. This came from a Supreme Court ruling in 1992, known as Quill versus North Dakota. And this ruling, however, did leave open the possibility of charging online businesses sales tax in the future. Online businesses have become a target by politicians as of late, and there are several concerns in regards to exempting these online businesses from sales tax. The first being not charging sales tax gives these large online retailers a price advantage of 4 to 9%, and this often hurts the small businesses who are often local to consumers and must charge these taxes. The second issue involves revenue. With an increase of businesses selling exclusively online, local and state governments are losing out on the revenue. So there's been a few recent efforts in regards to these problems. The first being the introduction of new legislation, and the streamlined sales and use tax agreement allows for a more uniform standard of rules on how and when a business can charge this sales tax, and this kind of levels the playing field for all the businesses involved. It was a cooperative effort involved by 44 of the states, which can join the agreement as also known as a member. The Main Street Fairness Act has also been recently introduced, and this would force large online retailers to pay a state and local sales tax. Now, small online retailers would still be exempt from this tax, but what is classified as a small retailer has not yet been established. And in order to exercise this authority, a state also has to sign on to the Streamlined Sales Agreement, which I mentioned before, and adopt the legislation implementing its provisions. The second strategy involves clarifying what a nexus is. Many companies used entity isolation in order to get around paying taxes. This basically meant that their e-commerce sites were considered separate legal entities unrelated to their physical stores. And recent laws have lessened the number of these, also known as click-and-mortar retailers. New York and 6 other states have recently implemented laws requiring online retailers to charge tax if they have sales affiliates in those states. So now I'm going to turn it over to Ryan. He's going to talk to you a little bit about exports.
Thanks, Devin. Texas does not require you to pay taxes on goods shipped by you or your business when you ship directly to your customer outside of Texas. But you do need to keep documents regarding interstate shipments. This documentation is required for goods shipped by land, air, or water. The seller will need to provide one of the following to the comptroller to substantiate a claim of export: a licensed U.S. Customs broker export certification, import documents issued by a foreign country, a bill of lading issued by a licensed and certified carrier showing the retailer as a shipper and delivery point outside of the United States, or an original airway, ocean, or railroad bill of landing with a freight forwarder's receipt. Sales taxes can be refunded if the buyer of the said items exports them outside the U.S. However, the sales tax must still be paid until after acceptable proof of export can be provided. Certification of the export needs to be held until 4 years after the export in order to claim the sales tax refund on the exported goods. In addition to collecting sales tax, when a business sells its merchandise, the owner also has to deal with use tax when he or she consumes his or her own goods. Use tax, also called purchases tax, are applied with the same rate as sales tax, which is 6.25% in Texas, and can also be increased by a maximum of 2% at the seller's discretion, raising the total tax charged to 8.25%. Most of the purchases realized by an owner are subject to use tax, yet several exemptions may occur. 1. The owner possesses a resale certificate to buy items in order to sell it again in the immediate future. There is no tax collected by the seller and thus no use tax for the buyer. However, if the buyer purchased items for another reason than reselling, he or she is liable for use tax. For example, free samples can be charged use tax. 2. The buyer possesses an exemption certificate. No sales tax will be collected by the seller and thus no use tax will occur. Yet if the buyer uses said goods for a non-exempt purpose, the buyer will be liable for use tax. An example of this is purchasing a manufacturing tool, yet using it for contractor work, which is a non-exempt use. 3. If the buyer paid a use tax from an out-of-state seller, the buyer doesn't need to report the amount of the purchase tax. The buyer must provide a receipt which highlights the amount of the use tax. However, if the purchase is realized with the same retailer without paying the Texas tax, and the new acquisition is used in Texas, then the buyer must pay use tax and report it. Goods purchased on the internet or via catalogs in Texas are also subject to use tax. In the same way as other goods, if the buyer purchased goods using the internet or catalogs from an out-of-state retailer but uses them in Texas, use tax is applicable. In order to report the use tax incurred, the buyer must use the Texas sales tax return document and use the line entitled Taxable Purchases. For owners who don't possess a tax permit, he or she must report the use tax on Form 01-156, Texas Use Tax. Finally, if the owner paid use tax for another state, he or she is eligible for a credit of the amount paid. And now Melanie will wrap up our presentation by telling us about who is exempt from sales tax. Melanie?
Now we're going to talk about exemptions. There are several different types of organizations that can be exempt from paying sales tax. What an organization needs to be exempt from paying sales tax is an exemption certificate. This certificate is used as proof for the business that's selling the item in record keeping and reporting that the item or service sold went to an exempt organization. So basically, the exemption certificate takes the place of the money that was not collected, and it is the buyer's responsibility to present the certificate at the time of purchase. There's some specific information that needs to be included on the certificate. The organization's name and location information, their Texas sales and use tax permit number, the name of the seller and description of the items to be purchased, and in the state of Texas, no exemption number is required, just the certificate. So what type of organizations are exempt? Religious organizations, charitable organizations, educational organizations, youth athletic organizations, volunteer fire departments, chambers of commerce and tourist promotional agencies, and political subdivisions. Now I'll just give you a few examples of some of those to help clarify the differences. An example of a religious organization would be St. Mary's Catholic Church here in College Station. Most churches are considered tax exempt as religious organizations. Charitable organizations include nonprofits such as the Red Cross or here locally Twin City Mission. Some educational organizations are obviously Texas A&M University as well as A&M Consolidated High School. And an example of a youth athletic organization would be the College Station Little League. Chambers of commerce and tourist agencies must represent at least one Texas city or county, are not organized for profit, and do not pass any earnings to shareholders to qualify. Political subdivisions are government agencies and departments in any county, city, school district, or other Texas political subdivision. Other exempt organizations can be found under Internal Revenue Code Section 501c3, C4, C8, C10, or C19. Also, the State of Texas website at window.state.texas.tx.us provides an online search that can be used to verify an organization's exemption status. For organizations applying for exemption, applications are available online. To summarize, to avoid paying sales tax, an organization must have an exemption certificate, and there's a list of organizations that are exempt that can be found on the window.state.tx.us website. As a business owner, records must be kept for tax purposes. These records are used by the Comptroller's Office to verify the accuracy of your sales and use tax liabilities. So who must keep records? According to Texas Administrative Code, those required to keep records are any sellers of taxable items and purchasers who store, use, or consume taxable items. Others listed include a person who sells, leases, or rents tangible personal property, a person who performs taxable labor such as fabricating, processing, and producing tangible personal property, and a person who purchases taxable items. What records are required? The records required must include the total gross receipt from sales, rentals, leases, taxable services, and taxable labor. Examples of this could be receipts, shipping manifests, invoices, and each taxable labor transaction that occurs during each reporting period. Also, the records required must include total purchases of taxable items, and additional records must be kept for any claimed deductions or exclusions authorized by law. Records can be kept in any form that the comptroller may readily examine and must be kept for at least 4 years. I hope you all learned a little more about sales tax today. Thank you for listening.